Please read the disclaimer. This video is for education and entertainment only. Nothing here is financial or investment advice. Always do your own research and speak with a professional before making financial decisions. Now, let me ask you something honestly. What if the reason XRP feels dead right now is not because it has failed, but because something much bigger is happening quietly in the background? What if the silence, the low volume, the boredom, the frustration, all of it is actually the setup phase? Because today we are talking about something that could change the entire XRP conversation. One name, one question. Is Blackrock preparing to step into the XRP ETF arena, or is this just another theory that ends up as a nothing burger? No hype, no clickbait promises, just facts, context, and logic. Welcome back to We Are Cosmic. If you are new here, this channel is about finance, crypto, and market psychology, explained in a way that normal people can actually understand. We don't scream moon. We don't sell fantasies. We break down what institutions are doing, what retail is feeling, and where probability really sits. My goal is not to make you excited for 5 minutes. My goal is to help you think clearly in a very noisy market. Now listen carefully, because this is important. Right now, the crypto market feels tired, XRP feels stuck, Bitcoin feels heavy, volumes are low, interest is low, liquidity is thin, and many people are quietly asking the same question: is this it? But in my experience, the moments when people feel the most disappointed are often the moments when smart money starts positioning. Not loudly, not emotionally, quietly. We're going to talk today about XRP's current price action, about Bitcoin, about why Sundays are often deceptive in crypto, and why low volume environments can be dangerous in both directions. We'll also talk about something most people miss: the difference between price and positioning. Because institutions do not buy the way retail buys. They don't chase green candles. They don't tweet emotions. They accumulate when nobody is watching. I also want to touch on 2026. Not with wild predictions, not with fake price targets, but with structure, regulation, ETFs, institutional frameworks. Because whether you like it or not, crypto is moving away from the Wild West phase and into the structured finance phase. And XRP sits right in the middle of that conversation. Before we go deeper, do me a favor. If you get value from calm, rational crypto analysis, smash that like button. It helps the channel reach people who are tired of hype and want clarity. And if you're not subscribed yet, this is your reminder. Subscribe and turn on notifications so you don't miss what's coming next. Trust me, the next phase of this market will confuse a lot of people. Right now, XRP is sitting around 187, basically flat. No fireworks, no excitement, and yes, I know, a lot of people are disappointed. But disappointment alone does not define failure. Context does. When volume is low, when liquidity is thin, and when retail interest is fading, price becomes easier to control. And that's exactly why these moments matter. One of the most interesting things we'll discuss today is a statement from a major ETF issuer who said something very telling. Retail is running away, while institutions are quietly buying. If that's true, and the data suggests it might be, then what we're seeing right now is not weakness, it's transition. So stay with me till the end of this video. We'll break down the charts, the psychology, the institutional angle, and yes, the Blackrock question. Because whether Blackrock launches an XRP ETF tomorrow or not, what they are doing behind the scenes tells us a lot about where this market is heading. One thing many retail traders don't understand is how low volume environments work. When volume is low, price does not need much force to move. That means sudden wicks, fake breakouts, fake breakdowns, and emotional reactions become more common. Sundays are especially tricky. Liquidity is thin, institutions are mostly inactive, and price can be pushed around much more easily. That's why you often see strange moves on Sundays that get completely reversed by Monday or Tuesday. Right now, XRP is in exactly that kind of environment: low interest, low volume, low liquidity. That does not automatically mean bullish or bearish. It simply means the market is fragile, and fragile markets are easy to manipulate. This is important to understand because many people look at flat price and assume nothing is happening. In reality, positioning can still be happening under the surface. If we zoom out to the weekly chart, the picture becomes clearer. XRP has been in a slow, grinding downtrend since its peak earlier in the year. Not a crash, not panic selling, just a controlled bleed. This kind of price action is actually very common after a strong run-up. Momentum cools off, indicators reset, and weak hands slowly exit. On the weekly stochastic RSI, XRP has been drifting down from overbought levels for months. That doesn't mean price must reverse immediately. Weekly timeframes move slowly, sometimes painfully slowly. In the past, XRP has stayed compressed in similar conditions for months before finally recovering. This is not unusual behavior. It just feels uncomfortable when you're living through it. Now, if we look at the daily technicals, things look even more pessimistic on the surface. Most moving averages, the 10, 20, 30, 50, 100, and 200, are flashing sell signals. And yes, that looks ugly. But here's the key point most people miss. Moving averages are lagging indicators. They tell you what has already happened, not what is about to happen. At the same time, some shorter-term indicators like momentum and MACD are starting to show early signs of stabilization, even mild buy signals on lower timeframes. That doesn't mean a rally is guaranteed. It simply means selling pressure is not accelerating anymore, and markets don't reverse when everyone is bullish. They reverse when selling gets exhausted. What's even more interesting is that Bitcoin looks very similar right now. Different chart, same structure, heavy moving averages, weak sentiment, low excitement. This tells us something important. XRP is not underperforming in isolation. The entire crypto market is in a pause phase. Correlation is still strong. This brings us to an uncomfortable truth. A lot of people are frustrated because they expected a big end-of-year rally. That expectation was reasonable. Historically, markets often perform well into year-end. But markets don't care about expectations. They care about liquidity, macro conditions, and positioning. When too many people expect the same outcome, the market often does the opposite. This is where psychology matters. Many retail investors are tired, they are bored, some are angry, some have simply stopped paying attention. You can see it on YouTube views, Google searches, and social engagement. Retail participation is fading. And historically, that tends to happen near market lows, not tops. That doesn't mean we instantly go up from here. It means the emotional crowd is stepping away. And when that happens, price discovery shifts from emotion-driven trading to capital-driven accumulation. Institutions don't need price to pump to accumulate. In fact, they prefer the opposite. So when you see XRP sitting at 187 and doing nothing, don't just ask, why isn't it going up? Ask a better question. Who benefits from this price staying boring? Because the answer to that question usually tells you more than the chart itself. You might have heard it before. Retail is running, institutions are buying, and that's not just a catchy phrase. It's literally what the data shows in many cases. Retail often reacts emotionally. They panic sell in downtrends, chase highs in uptrends, or simply exit when the news cycle gets boring. Institutions, on the other hand, have long-term strategies. They don't care if XRP dips 10% in a day. They care about building a position quietly without spiking the market. This is why low liquidity environments are perfect for them. They can buy large amounts through OTC, over-the-counter desks, block trades, or derivatives contracts without creating obvious price moves. Now let's bring ETFs into the picture. Exchange-traded funds are one of the main ways institutions participate without touching the spot market directly. Many people assume ETFs automatically pump the underlying asset. Not always. Often, ETFs accumulate silently, absorbing supply in ways that don't directly translate to exchange price spikes. Think of it like filling a bathtub with the drain open. Water is going in, but the level looks stable because some is also leaving elsewhere. That's exactly what can happen with XRP. Even if Blackrock or another major player launches an ETF tomorrow, it won't instantly moon the price. The accumulation will happen quietly, slowly, and strategically. This is where market manipulation discussions come in. Manipulation sounds shady, and in some cases it is, but it's also just market structure. When retail is exiting, price moves more easily. When institutions are buying in stealth, price appears flat or even down. And this is exactly what we're seeing. The CEO of Bitwise pointed out that retail is running while institutional investors quietly accumulate. It's the opposite of what most headlines show, but it's real and measurable. Let's connect this to the bigger picture. If institutions are quietly buying XRP, it creates scarcity. Exchanges have lower supply because coins are being moved off market. Prices don't explode yet, but the setup for a future move is being built. This is why long-term thinking is critical. You can't judge XRP's health solely on the day-to-day price. You have to look at positioning, supply constraints, and strategic accumulation. And now, the elephant in the room, BlackRock. Are they entering the XRP ETF space? Well, it's complicated. They've been hiring aggressively across Singapore, London, New York, Dublin, Boston, and San Francisco, focusing on digital assets, stablecoins, and tokenization. That doesn't guarantee an XRP ETF tomorrow, but it signals one thing. They are serious about crypto, and XRP is a candidate asset. Combine that with low exchange supply and ongoing institutional accumulation, and you start to see why current price stagnation doesn't mean failure. Here's the key takeaway for viewers. The market may feel boring or disappointing right now, but that's often the exact environment where smart money thrives. Retail frustration is the fog that hides accumulation. ETF infrastructure, regulation alignment, and institutional positioning are all quietly stacking the odds in favor of those who understand the setup. So don't focus only on price. Focus on market structure, liquidity, institutional behavior, and ETF dynamics. These are the forces that shape long-term trends, not short-term hype. And in the next part, we'll go deeper into regulatory developments, 2026 outlook, and how macro factors are likely to influence XRP and crypto at large, giving you a real edge to understand the bigger picture beyond daily price swings. First, let's talk macro trends. Interest rates, fiscal policies, global tensions, and technology adoption all influence crypto markets. For example, some projections for 2026 include potential interest rate reductions and renewed stimulus measures in major economies. Lower interest rates historically encourage investment in risk-on assets, which include stocks and cryptocurrencies. Meanwhile, AI adoption and capital expenditures in technology sectors are expected to rise sharply. When companies spend heavily on tech and digital infrastructure, investors often look for alternative assets to diversify exposure, and crypto fits into that narrative. Now, let's connect this to regulation. In 2026, U.S. regulators like the SEC and CFTC are expected to work more closely on crypto oversight. The SEC may focus on tokenization, while the CFTC could gain more power on derivatives and futures. This alignment matters. Why? Because when regulation is clear, institutional investors feel safer deploying capital. Ambiguity leads to hesitation. XRP, as a token that is already under regulatory discussion, benefits from clarity. Clear rules reduce risk for big players and allow ETFs and other financial products to operate more efficiently. This dovetails perfectly with ETF developments. If major institutions like Blackrock expand their crypto teams and product offerings, it signals readiness to engage heavily in the space. Even if an XRP ETF isn't announced tomorrow, the hiring patterns, product expansion, and tokenization initiatives indicate long-term commitment. The market may not react immediately, but foundations are being laid. Historically, these phases precede significant capital inflows. Let's also address retail sentiment. Retail participation may currently be low, but that is not necessarily negative. It often signals a market consolidation phase where emotional buyers have exited. When retail returns, it tends to amplify the moves already prepared by institutions. Think of it like a wave forming slowly underwater. The water looks calm at the surface, but the energy is already building. Institutional positioning, regulatory clarity, and macro trends are forming that wave. Another key factor is correlation with Bitcoin and other major assets. XRP has historically followed broader market trends. Right now, Bitcoin and XRP show similar technical structures, meaning overall crypto health affects XRP significantly. When macro factors like interest rates, regulatory clarity, and institutional flows line up, the entire market moves more predictably. That's why it's critical to understand the global context. It's not just XRP's own story. Finally, let's talk opportunity versus risk. We are entering a period where probabilities may be shifting in favor of those who understand structure. Price stagnation, low retail activity, and high institutional accumulation create a hidden edge for those who recognize it. Of course, risk still exists. Markets are never guaranteed, but knowledge of macro trends, ETF readiness, and regulatory alignment gives you a framework to make informed decisions rather than reacting emotionally. So, in summary, 2026 could be a pivotal year for crypto, and XRP sits at a crossroads. Macro policies, regulatory alignment, and institutional adoption are all stacking the deck for long-term positioning. Retail may feel frustrated now, but understanding these underlying forces is the difference between reacting and strategizing. Let's start with historical cycles. XRP, like most cryptocurrencies, tends to move in waves. These waves often follow periods of hype, consolidation, accumulation, and then breakout. For example, after the huge 2017 bull run, XRP spent months consolidating with low volatility and minimal retail interest. Then, as institutions began accumulating quietly, the stage was set for the next upward movement. What's critical here is recognizing that long-term trends are often built during periods that look boring or stagnant. Many retail investors miss these moments because they focus on immediate gains rather than structure. Next, let's talk about retail psychology. Retail traders tend to act emotionally. When price goes up rapidly, they chase. When price goes down, they panic sell. They often buy at tops and sell at bottoms. This pattern creates opportunities for those who can stay rational. Currently, we see retail sentiment at a low point. YouTube engagement, Google searches, and social chatter all suggest people are stepping back. While that may feel negative, history shows that periods of low retail participation often precede strong accumulation phases by institutions. This leads us to institutional behavior, which is almost the opposite of retail. Institutions are patient, strategic, and use sophisticated tools to accumulate assets quietly. They buy off exchange on OTC desks or through ETFs, carefully managing supply to avoid large price swings. This explains why XRP can sit relatively flat despite significant institutional interest. Understanding this difference between retail and institutional psychology is crucial. Price stagnation often does not mean lack of interest. It can mean accumulation behind the scenes. Let's also examine how past retail and institutional dynamics affected price movement. In 2020, for example, retail participation was high, interest rates were low, and stimulus checks were flowing. Markets rallied rapidly. XRP followed broader crypto trends. In contrast, after periods of retail exhaustion, XRP often experienced slow, measured recoveries as institutions quietly accumulated. Recognizing these patterns helps you avoid panic and stay aligned with long-term opportunities. Another lesson from history is the importance of positioning over timing. Many traders obsess over the perfect entry or the next pump, but the most successful investors focus on building a position gradually during both highs and lows and holding through periods of stagnation. By understanding cycles and psychology, you can better anticipate when accumulation phases may transition into price movement. Finally, there's a lesson in balancing optimism with realism. It's tempting to focus on potential $10, $100, or $1,000 targets, but the truth is that probabilities matter more than fantasies. Historical data shows that consistent strategic accumulation often leads to better long-term results than chasing hype. And if we combine that with current macro conditions, regulatory clarity, and ETF readiness, the groundwork for meaningful moves is being set, even if the retail crowd doesn't notice yet. So in summary, XRP's past teaches us that low retail sentiment is not necessarily bad. Institutional accumulation is often invisible but powerful. Historical cycles repeat in recognizable patterns, and patience and positioning outweigh emotional trading. By learning these lessons, you prepare yourself for what may come in 2026 without getting caught up in hype, false promises, or FOMO. Now we've reached the final part, and this is where all the pieces come together. We've analyzed XRP's price action, low volume behavior, institutional accumulation, ETFs, macro outlook, regulation, historical cycles, and psychology. But what does it all mean for you as a viewer and investor? Let's break it down into clear, actionable takeaways. 1. Focus on positioning, not price. The market may feel boring right now, and XRP may seem stagnant around 187. That's normal during low liquidity phases. Don't get distracted by short-term price movements. Instead, pay attention to accumulation trends, ETF activity, and institutional buying. These factors are harder to see, but far more powerful than daily fluctuations. 2. Understand retail versus institutional behavior. Retail often acts emotionally, selling during downtrends and chasing pumps. Institutions act strategically, quietly accumulating assets off exchange or through ETFs. When you know which side of the market is in control, you can align your strategy accordingly. Right now, data shows retail is stepping back while institutions quietly position. This is a key signal to be patient and observant rather than reactive. 3. Use historical cycles as a guide. XRP has moved in waves before: hype, consolidation, accumulation, breakout. Recognizing these patterns helps you understand the bigger picture instead of reacting to daily volatility. Periods of stagnation are often when future rallies are being built. History doesn't guarantee the future, but it offers context. 4. Keep macro trends and regulation in mind. Interest rates, stimulus policies, AI adoption, and capital expenditure cycles all impact crypto indirectly. Regulatory clarity from the SEC and CFTC is particularly important for XRP. When rules are clear, institutional participation grows, which can create a foundation for long-term moves. Staying informed about these factors is as important as chart reading. 5. Manage risk and practice patience. No investment is without risk. Markets can surprise, and emotional decisions often lead to losses. Use your knowledge to make calculated choices. Diversify holdings, avoid panic selling, and gradually build positions in line with strategic goals. Remember, crypto rewards patience and understanding more than it rewards hype chasing. 6. Don't fall for hype or false predictions. The internet is full of influencers promising unrealistic targets. Many have been wrong for months, yet they keep shifting predictions. Your advantage comes from clarity, research, and disciplined strategy, not chasing sensational claims. Stick with reliable sources, verify information, and make decisions based on probability and data, not excitement. 7. Be aware of market structure. Low liquidity, thin trading, and accumulation behind the scenes are creating a hidden setup. If institutions, ETFs, and tokenization efforts continue quietly, the market could see significant moves once retail interest returns or macro conditions trigger broader participation. Understanding this structure gives you foresight rather than hindsight. 8. Engage wisely. Follow channels like We Are Cosmic that break down complex financial topics in simple, logical terms. Avoid scams or fake social media contacts promising guaranteed gains. Education and informed decisions are your strongest tools in a complex, fast-moving market. To summarize, XRP is currently in a phase where price stagnation does not equal failure. Institutional accumulation, ETF developments, regulatory progress, and macro trends are quietly setting the stage for future opportunities. Retail frustration is natural, but often signals that the market is consolidating and preparing for the next phase. By focusing on positioning, cycles, macro understanding, and risk management, you can navigate the market strategically instead of reacting emotionally. Remember, the goal is not to chase quick profits. The goal is to understand the market deeply, recognize opportunities when they arise, and make informed decisions that protect and grow your capital over time. The foundation you lay now by observing, learning, and positioning wisely is what can give you a real edge in 2026 and beyond. So keep watching, keep learning, and stay patient. The market will move, and when it does, you want to be ready, not surprised. That's the We Are Cosmic way: calm, informed, and strategic.